lot of people ask me, Chris, what do you do? From a perspective, I say I get up Central Time, 4 to 5 o'clock every day, and I look at myself as a treasure hunter. I truly believe that there's buried treasure all over the world, and you just have to know how to read the maps. And as a treasure hunter, when you read maps, do you always find buried treasure? And the answer is no. Will we always find buried treasure within a pattern? It's no. But we can sure use them to increase the odds that that we're going to be successful. One thing I want to reinforce is that I personally am not a bull nor a bear. As I shared on the blog this morning, neither you nor I create these patterns. It's up to us to understand the patterns, understand why they were created, and what the message is behind them. So I would suggest for you not to be a bull or a bear. What do I think is dangerous is being a perma-bull or bear. And what do I mean by that? It's just either having a bullish attitude that things always has to go up, or the inverse, that the world's in a tough spot and you become bearish. My take is being a bull or a bear is nothing more than a psychological state of mind. It's not a strategy. Today is all about strategies. This is what I look after, like a couple of cups of Starbucks in the morning, and why do I find myself excited? This is my 32nd year in the business, and I'm excited not from the situation that the world is in. I'm excited for the opportunities that present themselves to all of us because of the investment tools that are available. It's amazing to me, maybe for some of you that are younger, that are on this call that haven't invested in a long time, some of the tools that are here today are just, well, that's the way it always was, but it wasn't always that way. And so the creation of, no matter what, the way I look at it is no matter how, if you were a forecaster and you saw you were perfect about your forecast in the future, and no matter where and how different things unfolded, there's a tool out there to make something from it. So the glass is always half full, and the opportunities have never been greater. The first Kimble key to success today is, if any of you on this phone call are gardeners, have gardens, know someone that's gardened, if they had a garden and they had some tomatoes in the backyard and they saw this very ripe tomato, what would you do with it? Would you harvest it? So here's the problem, I think. I mean, that seems obviously really simple when it comes to the gardening, but how does fear and greed and investments combine with this tomato story? Well, we have to realize that from the late 90s, the S&P went up 100%. Again, from 2000 to 2003, 2007 had a 100% rally. 2009, low, so not too long ago, almost another 100% rally again. So society's had three, the whole world could participate in this in the small world that we live in. There's been 3 100% rallies in the S&P 500, but why do people not have much to show for it? And I think it's the tomato story, and it's combined with greed. You know, how many people would sit there and just stare at the tomatoes and let them rot on the vine? But that's what's happening with investments. Why don't people have a lot to show for it? You know, the old saying, bulls make money, bears make money, and pigs get slaughtered. So we have to think in this type of environment, in a rowing environment, the key to our success is look at harvesting until we can work some of these things off. Sir John talked about that the 4 stages of a bull market are that bull markets are born on pessimism. And what's this guy's face look like? Is he excited or is he concerned? And when pessimism is rampant in the street, you'll see it in newspaper headlines, you'll see it on CNBC, you'll see it on Bloomberg, you'll see it in a lot of places. You'll hear it from your coworkers around at work, you'll hear it from family and friends. So be aware that bull markets are born on this pessimism. So not only listen for it, watch for it, and understand this psychological process. Then they grow on skepticism, they mature on optimism, and they die on euphoria. My strategy is named TBNM, which stands for tops, bottoms, and no middles. And why is that? Well, think about the 4 stages. If we want to buy low and sell high, we need to look at bull markets are born on pessimism, find tools and strategies that help us when pessimism is taking place and when lows have a chance of taking place, high probability patterns. And then we want to look at stage 4 at tops. when euphoria is present. The middle ground, why do I say no middles, is because the middle ground is pretty easy for all of us. If we get in a long-lasting bull market, we could turn to moving averages, and they can help us out there. So what I want to try to do is help all of you find those key exhaustion and reversal points. What does pessimism at market bottoms look like besides this in society? There's a lot of great patterns out there, but my favorite one at a bottoming process would be a falling wedge. And this is what a falling wedge looks like. And historically, the numbers come out, and this isn't from me, these are from many different resources that have tested these, is roughly 2/3 of the time this pattern breaks to the upside. So what's the ultimate in combinations? A falling wedge, if we can find support at the same time, and then we can go out and look at sentiment and find, let's say, whatever this product is, that there's maybe 5 to 10% bulls in this product. That's our ideal setup to put our capital at risk. Because I'm going to talk about, later, that this industry makes us all feel, makes a lot of people feel, that if you don't put your capital at risk every minute, every day of the week, in other words, if you don't dance to every song out there, there's something wrong with you. And that's just not true. There are times to put our hard-earned monies out on the table, and there's times to do nothing. And that's okay. Now, on the flip side, when things are euphoric, what do they look like at market tops besides cockiness? And like in 2006, I wish I could show it to you today, but in my Popular Delusions book, I found a USA Today article from 2006 that says 40% of new home sales are represented from second homes. Was that cocky or what and euphoric about real estate? That people had so much confidence that brick and mortar was going to go up. Let's just go buy another one. One isn't enough. Let's just get another one. And that was a heck of a sign in, we'll see later, the Dow Jones Home Construction Index. It looked like this, a rising wedge. And, I think it had been, I don't know, it was like 40 decades that across the United States on a United States basis, that real estate as a whole never had one down year. I mean, does it get any more euphoric at that time? So at peaks, we want to do what? Look for rising wedges, see if we can find other resistance channels, highs from the top, and if we can find sentiment studies where there's like 95% bulls. So I want to share with you, how do I use Metastock to reduce my own bias? Do all of you think I'm human? I am. Can I get wound up? Can I see the news? Can I become influenced by that? I can. So this is my own way to protect myself, from my own biases. So what I do is, this is a great part of the Metastock product, is I create a loop of charts, of around 130 charts, and I hide the names and the prices. This might sound a little bit familiar to you, what I show on the blog. And I start at a random point. I scroll through the charts. I look for high probability patterns, and I try to narrow it down to my top few. And then the last step I do from a discovery point of view is I find out what we're about to buy. This is my protection of myself, hence that's why you see the quizzes on the blog. This has been so productive for me, and I'm going to disclose this as far as some of my appreciation to you joining today's webinar. If you see a quiz on the blog, it's what I think is one of the best patterns that's extremely out of favor that I can uncover in this looping process. So keep that in mind. It's almost like I want to find a chart that has the greatest fingernails on a chalkboard irritation. And why is that? I'm not trying to irritate anyone. It's just it's at a sentiment extreme. This is a product that's either very high or very low. And if it's high, there's a lot of bulls that are very confident about it. And if it's very low, nobody believes in it. So I just want to share with you, when you see those, I think they're some of the best opportunities from a charting perspective we can find. But the take from this is how you can use software like this to protect yourself from your own bias or news-related opinions. How do you tell if a major market is close to a low? Sentiment extremes. I shared earlier that I've moved the majority of my practice over to to the RightX mutual fund family for several reasons: inverse funds, liquidity, low cost. This is what I think is one of the greatest things, that if these patterns would unfold, I don't know that they will, but if the traders around the world push these market lower, you want to look into, well, where would I try to buy bargains? And this is, I think, one of the greatest tools in helping you find where bottoms can come into play. And I provide this as far as research, and it's available in other sources. So this isn't something that I create, but this came from sentimenttrader.com. And what this is this is the S&P on top. This is a measure of their money market assets to all of their other funds. Again, the bottom blue line is the money in money markets divided by all their other funds. So when money starts running into their money markets, this ratio starts increasing. So you'll notice here in the 2002 lows that the scale off to the right is around 150. So what does that mean? That means that there's $1.50 in the money market fund for every buck that's in all of their other funds combined. So in other words, people have become pretty pessimistic. And one of the things I find interesting about sentiment polls / opinion polls is they are opinions. And I think, why do I think this is more valuable? Because this, folks, is an action poll. Have you ever, I have you ever lost money in a trade and you were underwater? Were you excited about taking the loss, or you didn't want to admit to it? See, that's a big psychological issue. So when this index rises, people are admitting they're scared and are actually taking action. So I think this is so vital over opinion polls. And that's not to knock opinion polls, but could somebody ask you, are you bullish or bearish on a poll or at work? And you could say, well, I don't like the way things are looking. I'm kind of scared, but yet you're still long your portfolio. That could happen in opinion polls. So last fall, when this hit 1.5, I sent out information out to premium members, and we'll discuss that later, suggesting that this was a good time to go long because how many people had decided to sell. And see, these are the times. So the take from this is, how do you tell when a market is closer to a major low? Is when you see people that have taken action and raised a ton of cash. And I will continue to get this updated to people. But right now you can see in the lower right that even with the decline that we've had, there's still, people haven't raised much cash. And that's not negative, but this tool isn't really good on tops. It's great on bottoms. One of our new, that you're seeing for the first time today, is what we call the Kimble Charting Solutions Global Dashboard. Well, what the heck is the dashboard? If you look at your car, there's a lot of different instruments that report different things that are important to you. How's my oil pressure, the temperature on the car, the speed, the RPM, and a lot of different things. And so we're going to report each week. We're going to share with you charts on the 3 key indices, or 3 large indices in the United States, the S&P, NASDAQ, and the Russell. We're also going to send you charts on what's the message from EFA and emerging markets, what's the pattern message in the commodities arena, focusing in on oil, gold, and silver, and then from the currency and the debt complex, the dollar, the euro, and bonds. So what would a dashboard look like? And I want to share that my intention is that it will be a global 28-second advantage. And I stole this from a customer of mine that's been around for well over a decade. And he said, Chris, what I like about your charts is I'm a busy person. I can see what the pattern, you helped assist me to share what the pattern was reflecting. I can see why I should do it. I can do it in 28 seconds or less, and I can get on with my day. I don't need a 30-page report. So this is what the global dashboard would look like. And you can see along the top, here's the S&P, the NASDAQ, and the Russell. You can see in the middle is the emerging markets and EFA and crude oil and gold, the 30-year bond, and the U.S. dollar. So once a week, if you want to have an easy snapshot of what's the world looking like from a pattern analysis, the red symbol are those bearish patterns. If they're bullish patterns, we're going to give a green light, and if the yellow light would reflect caution is in place. So if you would like these to get the global 28-second advantage sent to your email once a week, that you can just open it up and hey, here's where it is. I'll have somebody do this for me. You can get this once a week in your email box. Or on the web, we're constructing both pieces. Another one that I'm really excited about is looking for sectors that are at extremes combined with favorable price patterns. This is a new service that we call Sector Extremes. And what we'll do is, this is a service in and of itself, is that we will look at the 5 sectors, which is the green, that have the fewest amount of bulls, and the 5 sectors that there's the most extreme bulls. And then we're going to try to create chart patterns that go along with it. Now, 2 weeks ago today, natural gas was on the list of products with the least amount of bulls. Right here you see coffee, heating oil, OJ, soybean oil, and unleaded gas. The natural gas was in that list. So I did this post 2 weeks ago today, which reflected that what? Natural gas had this massive decline of almost 80%. What else do you see in this? Do you see a potential head and shoulders? This is a weekly pattern. Do you see that it happens to be reaching the 2001, 2002 levels when it went from $2 clear up to 16? Do you happen to see the potential of a falling wedge taking place at the same time? So at the top of the chart, you see natty gas was $2.15 a cubic foot at that time. And so here's an update on natty gas. It's hard to see, but up here in the upper left, this is as of 2 days ago, natty gas was $2.69 a cubic foot, doing its best to break out of the upside of this. So not a bad rally from $2.15 to $2.69, over 20% in a couple of weeks due to what? Patterns and being greatly out of favor. So these are the type of things, if you're interested in these shorter-term opportunities, and they can be long-term as well, but at these sector extremes, that's how you can take advantage of that. How could you have bought that? You know, you can do long natty gas futures. You can buy natural gas calls, but you could also buy UNG. But I'd say let's put a big asterisk next to that. Most of you are probably aware that the commodity-based ETFs have their challenges. Monthly rollover, contango, and you name it. So if you want, you can buy UNG, you know, with this. But I also want to say be very careful due to the challenges and pricing discrepancies of the commodity-based ETFs. I know somebody's going to ask, well, how can you play this on an ETF basis? UNG is how you can, but also be very, very careful with that product itself. So what's an extreme today? So here's an example of something we shared a couple of days ago with the premium members that are getting the service. This is coffee. This is the 2000 low at $40, clear up here to 300. So a 10-year rally that went up an astronomical percent. But the point is that took place. Where are we today? So let's look at a couple of pieces. Coffee has declined over 50% in 13 months. That 50% decline has taken it down to its 61% Fibonacci support level of this entire move. You can see some emotional bottoms that took place coming into play, you know, right here. And where is sentiment? Sentiment stands at 17%. Very, very few bulls. And so just to recap why we see this for active traders as a sentiment extreme, 50% decline in 13 months at the 61% fib ratio on support and only 17% bulls. And just look at the opposite, everybody. When coffee was at $300, where was sentiment? It was just under 90% bulls. So remember, bull markets are born on pessimism at your bottoms, and they die on what? Euphoria. So we're trying to dig in and lift up the hood and see where is sentiment extremes taking place in sectors. And what you could do here is you could be buying long coffee futures, long coffee calls, or an ETF similar to UNG is JO. So this would be an extreme to be a buyer, and then you'd want to have a stop in here that's comfortable to your risk tolerance levels, because you cannot overlook that you could cram an Eiffel Tower in there, and that we could be experiencing the right side of that Eiffel Tower. So if the 61% fib level goes, here, despite sentiment being overdone, it could be in trouble. So be a buyer on support, sentiment extreme, with a stop. This is the type of information that you'll be getting if you care to get this type of research. Each week we'll look at the 5 most out of favor and the 5 most bullish or most favorable, and then I want to take those sentiment extremes, apply pattern analysis, and use that research to our advantage. I played baseball in college, and I like baseball a lot, but we're going to go back to the behavioral book of investing, and Ted Williams, one of the best hitters in all of the history of baseball, and you see this kind of little busy graphic to the right. Ted used to say that he would take the strike zone and divide it into 77 different cells the size of baseballs. And one of the interesting things that Montier brings up about Ted Williams in this is when Ted was at bat, if he had 2 strikes on him, Ted knew where the unfavorable cells were down in here in his batting average. And so if the pitch was made and he had 2 strikes and the ball was in that part of the strike zone, what did he do? He just stood there and watched it. He said it was better to strike out and not swing at an unfavorable probability than to swing in those bad or poor conditions. And why did Montier bring this up, and why do I find it of value, or what to take from this slide? I want you to look for high probability patterns, and when that pattern is not there, just don't take a position. Don't go along the line that just because the market is open and the music is playing, you don't have to dance. And this was a great example. This is from another value, I think, from the little book of behavioral investing.